Good morning. It is Friday, May 27th. It's 11 o'clock in the morning, and this is the day before the Memorial Day weekend here in the States. So we have a 3-day weekend. We won't be getting back to business after today until next Tuesday. And hopefully it's a great weekend, a long weekend for all of you. It's officially I guess you could say it's almost like the official start of summer here in the States. And that means barbecues. And today there will be, I'm sure, parades all over the place, small town parades, that sort of thing. All the little league baseball teams and, the high school bands and veterans will be walking the streets of Maintown, USA. And that's the way things roll here. And everybody gets ready for the summer. So today, I would imagine, is usually a relatively low impact day. A lot of people are getting ready for that weekend, or mentally or whatever. The market this morning is up. We did our analysis this morning and predicted that it would be up. Well, one of two scenarios. One of the scenarios that we would move up out of the current volume node, and we're already in kind of a short term or a near term. The momentum is up for the past few days, so there was no reason to suspect or expect anything different from today, particularly right before this long weekend. You would think that people would want to just keep on pushing it up. There probably wouldn't be too much resistance. And so that was our call. And even so, even though there was relatively negative economic reports this morning, that didn't seem to really matter. I think we're running into this sort of opposite world again, where good news is bad and bad news is good. So, so that was our prediction. So let's take a look at where we're at right now. So you see market reports came out right about here, right there. And we took off, and this green line is the LVN. T0 is a volume node that we're on. And so the idea here was that, hey, we come up to this LVN and we either get rejected there and come back, or we continue up. So far, we're continuing up. There's a little bit of a dip right now. I'm not sure what that's all about, but probably just a little bit of profit taking after such a strong move up. I mean, from the bottom here, we went from 40.58 to as high as, we went about 65, 68 points from bottom to top, when the expected move was really only about 40 points for today. But now that we're up here, there's no reason to expect that we won't reach to the next destination, which would be the volume node above. And so if we were to move back a little bit, we can see where that is. And that's T1. So we spent a good amount of time this week in T2 down here. And then last week on Friday, this little dip here dipped us into bear territory. The market didn't like that. And ever since we rejected that idea, the market has been pushing upwards. There was another attempt at it on Tuesday here, and that was quickly rejected. And we've been grinding up ever since. Big move yesterday to bring us up to this next volume node, T0. And now this morning, another big move. I fully expect that that's where our next destination will be, this next volume node. So that's basically where we're at right now. So I fully expect that we'll move up to T1 now. I routinely, yesterday we were calling this T3 because we thought that T1 would be down here. We were closer to T1 than up here. So we reorder these routinely every time if necessary, just to indicate by the number where we think the next destination is, right? So we put it in numerical order, and that's just simply the T, I guess you could say, stands for target. It's always inside of a volume node because volume nodes tend to have gravitas to them. So when price is generally looking for high volume areas or areas where the market finds value, so we call those targets. And it's just a way for us to label things so that we have a common lexicon while we're talking about it during the day. So that's the only significance that it has. So as I said, we've moved up fairly strongly. We went through the LVN. The LVN is the low point inside of the volume well, which is between two volume nodes. So we have the T0 and the T1 node, and then there's this vacuous area of volume. And you can see that when we go back to, say, a much longer term chart. And we'll bring that in here so you can see that. All right, so you can see this big vacuous area here. Big, huge volume well. And the green lines are pointing out the very low points in those wells. Those tend to be kind of inflection points, right? And then we have this minor node, T0, that got developed because this well is so big. We had this sort of, I guess you could call it a child node that was developed, almost like a landing pad, so to speak, as price tried to traverse this huge volume well. Generally, price tends to go through these wells very, very quickly. As you can see, it did way back here last year, just moves right through it until we find another area of value. And now we're retracing our moves from last year in the opposite direction. We've come down. Now, it was such a long distance that we came down here, found value here at T2, moved back up. That wasn't far enough. So we had to find this area T0 where we hang out a little bit. It's kind of like the landing pad. It's the halfway point in between this huge crevasse. And then we moved down and tried to break the 20% retracement or 20% pullback, and that got soundly rejected. And since then, we've been moving up. And each day we evaluate price, and we've been steadily getting it right, saying that price is moving up, and it has been. Along the way, we placed this green line right here at 4,100 to indicate another low point in that well, because those low points tend to be places where institutions hang out and try to make those like lines of demarcation. So we point them out as possible places that we could use to take trades or whatever. All right, so let's zoom in on that area. We'll go to an hour view so you can kind of see. There's T2, there's T0. Now you don't see T0 anymore because that volume and most of that activity was created a while back. And you don't see T1 for the same reason. But if we brought in some more, you would start see T1. So in the longer term charts, these value nodes have more definition. So we mark them up in those longer terms so that when we're inside the woods, we can still see the forest, so to speak. And then from that, we use those as our guidelines when we're trading. Now, there's a lot of congestion here at this level in the past month or so. So all of this has gravitas and impact, but there's still a lot of impact up in T1. So we still think that price will move up here. It's very possible we'll just hang out right here, and that's the extent of the move. If that's the case, then that's the case, right? But we're in like I said, it's a low liquidity day before the weekend. We've already moved up quite a bit. If we take a look at the expected move up to this point now, It was 40 points when we started the day. There's still almost, a little over 27 points left. So, it's very possible that we could, move up another, say, 30 points up to, this area. If we get up here quickly, then there's no reason not to expect that we won't get inside this volume node. So anyways, that's our analysis for the day. We can zoom in on a much smaller time frame so that we can see a little bit more detail. Maybe even go to 3 minutes. All right. So we've shot up pretty fast. That's quite a move out of the gate. And again, I think that's because of the relatively low liquidity today, being it a day before a long weekend. And so that's another reason why I think that there's a very good chance that we could continue to move up. So a trade that I put on was one where we would ultimately move up into the T1 node up here. And I chose 41.55 for my center strike, and I made it 15 wide. So as low as 41.45 would be, one of the legs, 41.40 rather, 41.55, and then 41.70 is the trade that I took. And you can see that here. So this is the trade right here. Now one of the reasons why I took that is that, I evaluated, well, what's the probability of touch from where we took the trade to this first leg, right? And we can look at that inside the options chain. I have that set up here. We can use a different column designation here. And so getting up to 41.40 right here is about a 50-50 proposition, right? At the time that I took the trade, it was a little bit higher. It was almost 60%. And that makes sense to us because, from our point of view, trades that have a 50-50 proposition have huge positive expectancy over the long term. And I showed that yesterday when we were looking at this way to simulate the markets. Here, I'll show you here. So this is a long-term simulator of doing the 0 DTE trades and showing the type of risk to reward that we take and the potential profit that we get and the win rate. And then we simulate 3 different types of traders with 3 different account sizes. And we can see even at 45%, we have pretty good positive expectancy. Now, we could, try a different simulation just by recalculating everything. All right, we can do this, dozens of times. And every time we do it, no matter when you do it, you still have that positive expectancy. So we know that by placing a trade where we're at least, and that's at 45%. I mean, if I change this to 50%, then we have even a better chance of profiting long term. So that's basically what this simulation. Now this is, doing this is no guarantee that we're going to make these kind of returns over the long run. This is all assuming that our process is clean and that we don't make mistakes, that we put on the same kind of trades, we shoot for that 50% or better, etc. That we take this type of risk to reward scenario. All of those things kind of move into it, and then just using a standard deviation and normal distribution. These are the kind of the numbers that one might expect from a statistical point of view. Of course, statistics are statistics. They're just averages. They're not the real life situation. you can get closer to the real life situation, the better your process is, the more consistent you are with your trades, etc. But what it's showing is that when you take low risk and high potential reward, and even at a small win rate, you have a positive expectancy. And so that is the philosophy behind this and how we choose the strikes to some degree. All right, so we'll choose those strikes that are within that kind of range. So right now, that 4140 is right at about 50%. See, and that's the 4140 call down here is the the low side. So I would expect to move into that. Now, if we were to move into that right now to 4140, that would produce a nice little profit. It would produce about a $150 return on our $200 potential risk, right? If we can get, now, if we stayed here for the day, and then as time wore on and premium decayed, this purple profit line would start rising, and we would actually have the potential to make much better profit. If we can get inside of the profit tent and ride that out right to the end of the day, there's the possibility that we could make a lot more money on our risk. So, as the day moves on and wears on, and if it continues to climb up towards this, the odds of us coming out with a positive day get better and better and better. And it looks that way. It looks like we're going to come up here. If we can break a new high, then we'll probably run into T1, and it will be a nice trade. So that's kind of like the thinking and the thought process that goes through when choosing the strikes. Of course, our underlying criteria are that we always take a. Yeah, let me bring the big head back here. So in this type of trading, the zero DTE, there are a number of things that we have going for us. One is that because it's a zero DTE day, or 0 days to expiration, the very last day of expiration, we know that the premium in these trades is going to be decaying at its quickest rate and exponentially faster and faster as we approach to the end of the day until it's completely decayed. Now, decayed if you look at it from the inverse, that means that if we're inside of a premium collection strategy, that means that decay is actually turning into profit for us. So it's almost like we're trading with the wind at our back, so to speak. And so if we can put ourselves inside or near that rising tide, so to speak, then we have a very high likelihood that we can achieve a positive result for the day. So that's basically how we do it. And we want to put on an asymmetric trade where we never take much more than that well-defined risk, but we always have that positive potential that is much larger than that. And our minimum risk to reward is 1 to 5. We often try to put on something better than that, maybe a 1 to 8 or a 1 to 12 or even a 1 to 15. As long as we can get that probability of touch within our range. Now, today's trade was put on with a probability of touch of about 55% when I originally put it on. And you saw through the simulation that a 55% probability of touch produces an extremely high positive expectancy. In other words, you're going to have one of these equity curves that goes from bottom left to top right. I mean, sure, there's going to be some waves along the way. And in fact, if you were to take a look at that, all of the other parts of that, let me show you. So let's just suppose that we choose a win rate of 50%. You can see our max risk is between 100 and 225. So this would give us sort of an average somewhere around there. On this particular trade, my risk was about $2. Some people put the trade on, they got in as low as $1.80. So that's within that range. And you can see the win is between 100 and 700. Now, we lowball this. We don't actually choose the top potential because it's kind of rare that you would pin a trade exactly on the very highest point. So it makes more sense to maybe lop off about 40% of it. And so even recognizing that about 5 to 15% of the time, 10 to 15% of the time, that we actually are hitting that pin trade and getting a much higher result. But we're trying to be conservative here. All right, so that's the setup for our trade. You can see there are 3 scenarios here for different traders, starting capital and their size of their position, and then what they can expect after about, if they follow our strategy, after about 500 trades, or about almost 2 years worth of activity. It could be a little less than 2 years, a year and a half. There's about 220 trading days, and we trade about 3 times a week for the earlier day trade, and we're doing the late day trade 5 times a week. So you could say that in a year it's probably not out of the question to have 250 to 300 trades. So this is a good approximation. But as you can see, all of these are not straight lines. There are some cases, and if we were to just recalculate this, we could see that there are different cases here. Like in this scenario here, the trader 3 has a big drawdown here. But that drawdown never really got beyond 9.5%. So you can see down here in the bottom part of the table, 9.5%. And for the trader with the smaller account, they did have there's usually more volatility when you have a smaller account because the size of trades relative to the size of your account means that you're going to have more volatility in your equity. So there was a 15% max drawdown somewhere inside of that 2-year period, or that 500 trade period. And then you can see what the the largest winners and the largest losers are in this particular scenario, what our average win to loss ratio is. And that's pretty much in line with what we've seen over the past year. About a 2 to 2.5 times return on our risk. And so we chose a 50% win rate. The actual that came out was 47%. So all of this, is basically saying that, look, after, and this is the crazy part, that after 2 years, starting with a $5,000 account, it's possible, following this strategy, that you could turn that $5,000 into $40,000. Of course, that's compounded, so that's how it all works. The compounding is the key. As you're continuing to trade, you're increasing your position size as a percent of your capital. Right? So all very interesting. All right, so that's the reasoning behind the trade, why we chose the strikes that we did, and what we hope to expect as we move further on into the day. Right now, we'll go back to the chart. We can see that we had a little bit of a correction here. It looks like we're moving up. If we can break through and set a new high, I think that we'll have another leg up. And the closer we get to this T0, the more gravitas it will have. It's kind of like physics, or a larger, massive type of thing has a greater gravitational effect to what comes near it. It's the same thing with, in a lot of ways, you can look at market data in the same way. It has this sort of physical property to it. Some people like to look at it from a fluid dynamics point of view, or some from just a plain physics point of view. But the reality is that the reason why there are volume nodes is that the market has found value there collectively. And so when you get near that area, for whatever reason, people tend to want to stay there. In between those areas, in between value nodes, are these vacuous areas that we call volume wells. For whatever reason, the market doesn't want to be there. And so price tends to move very quickly through those areas. If it's an exceedingly large vacuous area, that's a long way to traverse from one value node to the next, then you're going to get some intermediate, stop-off points where, you just don't have the facility to get from one side to the other, so you stop there and maybe hang out, and you could possibly create another minor value node there. And so everything like this is kind of fractal in nature. In the long term, you start seeing areas that get built up, and in the short term, you start seeing things that get built up as well. But in the aggregate, the long term will show you where the real value is and where the real value isn't. Hopefully that makes sense. So that was the reasoning behind today's trade. We look at the trade as no different than any other trade. We just simply put them on according to those specifications that we use, and we try to, maintain the discipline to put trades on based on our analysis and the criteria that we use. We try to stay above 1 to 5 risk to reward, try to put on things that have a probability of touch that are at least 50 or 55%. If we can get higher, that would be great. Sometimes the market will afford that to us, depends on the amount of volatility that's in the market. And by sticking to those criteria and then having asymmetric trades, that's the real key. So there are a couple of edges that we have here. The asymmetry by itself, from a statistical point of view, will give you a positive expectancy over the long term. The implied volatility, which is usually overstated, also gives us an edge there because, in general, options are overpriced. And so by selling premium, we are essentially selling things that are overpriced. So there's a slight edge there. And then through our analysis and our volumetric analysis and being able to look at order flow and determine direction, we are more often than not being able to predict the direction of the market within a very small period of time relatively accurately, usually within 65 to 75% accuracy, sometimes better. So all of those combined give us a very, very good chance for winning in the long term. The key for us is becoming disciplined and consistent with the way we put things on. And all that comes down to is developing our personal trading process, our analysis process, our execution process, our management process. And instead of being so goal-oriented, the way some people are, they want to achieve a certain income from their trading, we don't believe that that's possible because the market isn't here to give us an income. The market is here to give us opportunity. All we can do is overlay our strategy and our process on top of that opportunity and take what it will give us. So that's the real key to zero-DTE. If you'd like to give this a shot, go to zero-dte.com/try, do a 4-week trial, and see for yourself. Many people that take the trial find that they've made enough during the trial itself, and they've learned enough that they actually make enough to pay for a year or multiple years of the cost of the service. So really nothing to lose, and if you join the service for whatever plan that you choose, I will rebate the cost of the trial. All right, there we go. Geez, no questions from the peanut gallery today. We do have a hello from France. Thank you very much, Video Boris. A lot of times what happens is that the members are asking questions or making comments from the Discord. So that looks like it. Hey Eric, how you doing? But, we know that they're out there because there are currently, how many people are online? Let's find out. There are currently about 40 people online. Cool. About 33, it looks like right now. All right. So we have some other people chiming in now. Eric saying, late still with the PDT rule, but learning. So that's a good point, Eric. A lot of people, now we trade options on the SPX or the E-mini S&P, but primarily the SPX. And if you have a smaller account, then you know that you can't make too many trades during a week that open and close because you'll fall into or be subject to the pattern day trader rule. We have a way that you can completely sidestep the pattern day trader rule with a small account and not ever get a strike against you. And so it's a way that you can lock in your profits and essentially flatten out a trade and then not worry about closing it. As long as you don't close the trade and you flatten it with an opposing trade, you can get out of that getting that strike. And so therefore you can trade with a small account, trading the SPX or the XSP or XPS or anything that you choose without having to worry about getting tagged as a pattern day trader. So that's an interesting thing, and Erica is practicing that. Jeffrey's saying, do you look at put on a tranche when there is a correction? Oh, do you look to put on a tranche when there is a correction? So what he's asking there is, do we add to our trade? So one of the principles of when we are setting up our account and deciding on our risk is deciding on what is the max risk that we are willing to take in any trade. And if your account is big, then you might be able to put on several positions. Does that mean that you have to put on several positions every time you take a trade? Absolutely not. Instead, what you should be doing is putting on, let's say that you had a $50,000 account and we opened up this trade and you said, oh, look, I could put on 10 of these. Do you put 10 on right away? That would be crazy. Now, 10 trades might get you to your minimum risk or your maximum risk position that you're willing to take in any one trade, but why would you do that? You may start off by maybe splitting up those 10 positions into, I don't know, 3 tranches, maybe 3, 3, 4, or something like that, and put on the first 3 and see if that works for you. And if there's a slight pullback, as what Jeffrey is suggesting, put on the next tranche. Each one of those groupings of positions we would call a tranche or a part of. That's literally what tranche means. It's a part of a bigger whole. So you can develop strategies like that. And we have strategies where we decide, what is the proper amount of things to put on and when to add to a trade, when to subtract from a trade. So all of those become more sophisticated trade management or profit management as we get further and further into our knowledge of trading this system. Okay. Stuart says, great presentation explanations. Thanks for all the efforts to educate. Now, there's one thing that I want to point out to everybody, that this is not an alert service. However, we do provide alerts and help people get into certain trades, etc. But this is really an educational service. I'm here to provide coaching and mentoring to our students and our members. The goal here is to make you completely an independent practitioner of this system, the process, the strategies and all the methodologies that we do. And so that's what it's all about. And that's one of the reasons why we have a 4-week trial as opposed to what most people do is a 1-week trial. They want you to just get a quick taste and then, either you make that decision. But 4 weeks, you should start to be able to get a real feel for what it's like to be a member here. And we have a vibrant community of traders from professionals down to newbies. And you'd be surprised. We have a lot of people that are new to options and they're learning. And the same thing with the professionals. The thing is that when you come in here as someone who has been a professional or a very experienced trader, it's going to be a completely different mindset. And it's at first, for those people who are very experienced, it's challenging because they have to kind of divorce themselves from all the baggage that they've accumulated over time and start saying, look, you have to look at trades very differently. Instead of looking at the high probability trades with tiny potential profit and thinking that that's going to bring you to nirvana, that actually has a negative expectancy. You have to flip all of that and start looking at asymmetric trades where you're taking tiny risks for outsized profits. Now, of course, your win rate is going to be lower, and that might be the cognitive dissonance that people have, that they can't take that lower win rate. But your potential and your outcome is going to be much better, and with much less volatility in the growth of your equity. So that's what you learn here when you join our service. Eric says the pattern day trader hack used to do it with CS. Thanks. Watch the butterfly pattern trade video. Will do for sure when 90 days pass. Oh, so so there's somebody that got tagged with the pattern day trader rule. In our service, we have a methodology for avoiding it. So he's found that, now is trying through simulation to become experienced at that, so that when they're let back online, they'll have that solution, and that will never happen again. Fantastic. There is a video. Okay. And Dane is explaining. Yes, there is that video there. And Swede, why not trade other futures? YM, NQ, RTY, CL, etc. Well, first of all, the SPX has 5 expiries, 50 DTE events every week. Now, the only other index that has that is the NQ. But the NQ is far more volatile and far more expensive. So that's one of the reasons why we kind of stay away from that. And the liquidity is much lower. So it's a much more difficult thing to trade. The SPX is relatively easy to trade. So that's why we do that. But there is really no reason why you can't trade these others. It's just that you won't have 5 opportunities a week. You may have 1 a week, right? So that's basically why. And, we don't want to complicate matters. We're trying to keep things here as simple as possible. Let's just focus on the SPX. Then we only have to worry about one index and one market, and it is the biggest market. And, of course, most of the things that are present